What's up, guys? I hope you're all doing well. So, I haven't done a video in a big while, so I thought it would be a great thing to do a video about something really important, content wise, trading wise, and then to once again showcase the trade recap that I have taken today, which have um, closed out in 26 plus 14, which is 40 RR, but it could have been, as you can see, 44 plus 23. So it's like 67, but I'm still happy with what I have closed out. All right. Um, the two topics that I will go through in this video are probably most important for me. It's supply to demand flip or demand to supply flip, and then some rules on how to pick the order blocks or supply and demands. Because as you know, when you look at the chart, you can spot supply and demand pretty easily, but you don't really know what to pick, what to look at. And the problem is that we don't really know what supply and demand will play out eventually, right? We may anticipate, we may expect this or that supply and demand to hold, but we don't really know that for sure. It all comes down to the reaction this or that supply gives us. If there is no reaction, on lower time frames, then you just delete the markup of that supply demand, right? But what is most important is the follow through it gives. If there is no follow through, but a reaction, which will be most of the times by any supply and demand, um, then of course that makes the situation a bit hard for us traders, right? But yeah, without further ado, without much waffling, I think let's get started. As always, I think my video will be long because this is not me wanting to talk a lot. It's just the concepts that take much time to explain them, to show them properly, to draw the schematics, right? And we'll start from supply to demand flips, right? In this situation, what we have is that during the bullish time frame, or I mean bullish trend, what actually happens is that our um, supply gets broken, right? And demand prevails, which means that demand is stronger. It breaks the supply and breaks the supply in these points, right? In here. And in here we have our supplies, right? Just bear with me, I will do a quick schematic, right? So at this point, we understand that we have this demand. The anticipation is that the price will somewhat correctively or impulsively retrace back to this demand, and then will show some reaction on lower time frames, and then it will go higher, right? Um, so this means that we want to be looking in here, in this zone right here. We want to be looking for a supply demand flip, which means that for some time there was supply in control, which means that supply was prevailing the demand. Let me finish doing that. Okay. Right. So we have our supply controlling environment, right? This is our supply holding and once again breaking the demand, right? What we want to see is supply actually given a reaction. One sec, please. What we want to see is supply given a reaction in here in this zone, but then failing to break this low, which will then mean that the demand in here held, right? Which then means that we are now in the environment that there is no something that is stronger than the other, right? So in this position, we're just waiting. When we have this reaction and then we have a follow through, that this is the follow through, right? This is the follow through, which breaks so as this substructure, as well as this um, more important structure. And of course, it breaks oops, breaks that supply, this one supply, right? The supply to demand flip is not just supply getting broken, right? It is the demand getting the reaction point out, all right? So this is our reaction point to the supply that is marked out with red, and the demand that took out this reaction point in here, I have just marked it out. Let's make it yellow, right? So, man, my bad. Okay. So this yellow demand took out the supply by taking out the reaction point of the supply, all right? So that means that this demand is now absolutely valid, all right? And we want to be looking to sell, to buy from this demand, right? And once again, the price may have, mitigated something even higher like this. And then what did the price fail? The price failed to break this low and to break this low, which means that this high is now weak, and this low, so as this low after a break of this pointer structure, is now protected by the banks and financial institutions. So in this point, we want to be, and we will be, easily buying from that zone, right? Okay, this is pretty much easy, but still sometimes people don't really understand it, and they're looking at the thing and they're either seeing it wrong, or they want to see what the price doesn't actually show. And by that I mean is, let's say there was no reaction to the supply. Let's say it was like one single lag like this, like the price just with no consideration, like it just broken the supply, right? If there is no reaction, then this is not a demand to supply flip or supply to demand flip. Why? Because um, if there is no reaction like this, there is no demand, supply in here. So as there is no supply in here. Why? Because supply is the level where there are orders, and these orders should be they should be filled. Like these sell orders should be filled with buy orders, and this interaction between sellers and buyers is showed with the help of candles. And whenever we see a somewhat, even like this small reaction with one candle, this is still reaction, okay? And then we of course see that this reaction point gets taken out, and we can either buy from this demand or this extreme demand, like, right? Um, what Autoblock to pick, I will talk about it later, because just for now we're sitting with um, supply and demand flips, all right? But yeah, if there is no reaction to the supply, or um, let's make it like there is no reaction to the demand, right? Then there is no demand in here, because there is no interaction between buyers and sellers. Okay, that means that there are no orders resting in these levels to fill. And if, let's say, there was a some demand in here, yeah, like this, right, and the price then reacts, we may as well sweep this high like that. Okay, why? Because these levels were not demand levels, so there is no, as I have said already, interaction between buyers and sellers, which means that these may be only pauses on the market, right? And a proper continuation buy will happen after these levels will get swept and used for liquidity purposes, and then the price will then go even higher. All right. So yeah, we always want to see a reaction. Okay, we always want to see a reaction, because in this level we have an interaction between buyers and sellers, and then at the end of the day, this break of the supply and this 2 points, right, of this of this supply and these 2 points, it means that the demand has overpowered the supply, which means that there is an imbalance between them, and buyers are now in control, looking for liquidity to fill their orders, and yeah, it's the right time to buy. Okay. um, so the same happens with the uh, reverse trades. It's just not buy, not sell to buy, but buy to sell, when we have like this and we want to see a reaction, a fail of break on this low, demand getting respected, supply and these 2 points getting broken, then retracement to the supply. I mean, yeah, to the supply, and then the follow through. All right. Um, I hope these drawings actually make sense for you. Uh, if not, um, pause the video and try to get them better looking on your charts by copying mine. Okay. Now let's delete all that. So yeah, this is for me one of the most important concepts in terms of my entries. As you can see, I have 5 criterias to be met when I am looking for entries, and the sixth one is the question overall, and the flip is the last point that I want to see. Okay, because the flip shows and answers the main question, who's in control, and we always want to be looking at the trades that actually follow the direction of the price and follow the direction of the intentions of the banks and financial institutions, that actually show who's in control. Okay. um, so yeah, flip is really important, and when you don't really understand what flip is, or you're marking it out not properly, or you're looking at some zones that you think that flip was there, but there wasn't any interaction between buyers and sellers, and you actually then, let's say you're buying, but then you're getting taken out, and like you're asking why. Well, the main reason why is that because there was no yet to be seen a interaction between buyers and sellers, which then leads to the fact that there was no um, change in control, which means that if you were looking to buy, there was no indication to buy yet because the sales or supply is still in control. Okay, I hope that makes sense. If not, feel free to ask the questions on any social media you can find me on. But yeah, the next topic is Autoblock filtering, right? Um, for me, I have three main criterias that I'm looking at when I'm marking out my order blocks. Uh, the first one is, did the order block or supply and demand take liquidity? If it did, then this zone for me is really more valid than the zone that didn't really take liquidity for one simple reason. The zones that really take liquidity, they have fuel behind the price, and I mean behind the move to move the price in the necessary direction, right? If I want to bring the price, uh, let's say from here to the downside, right? Um, I need fuel for that. The same as a car, you know, traveling to some destination, right? You need to fuel your car in order to get there. If you don't have any fuel, then you will not get there. The same goes with price, taking out liquidity for then to move in a proper direction. Okay, so this is criteria number one. I will actually read it. First one is, uh, did it take liquidity? The second one is, did it break some point of structure? In this case, I will explain myself. Why did I write some point of structure, right? Um, there are a lot of approaches to trading, and a lot of you guys trade differently, right? Some of you guys are trading only breaks of structure. Some of you trading like minor both breaks of structure and substructures, right? And when you have three types of marking your structure out, then that means that some order blocks may not be valid because they didn't really break the swing point, because breaks of structure initially were always about the breaks of swing points, which are the highest and the lowest in the lag. And some of them, they don't really break them, right? So that means that some of the order blocks may not be valid just for that simple reason. So in this case, it always comes down to what your uh, trading style is. But for me, I don't really use minor structure and substructure breaks of structure because I like to keep it simple. And if the order block break any high or low, which means closed above or below it, then this is a plus confluence for my zone. And the third one is, um, what move looks like. In here, I mean, is it corrective or impulsive? We always want to be looking at some impulsive uh, moves, because then that means that the intention is clearly to that side, and this is the indication that the bank or financial institution uh, was behind this move to some extent, because when it's corrective, I mean, it looks for me more so as a accumulation of liquidity on both sides, and yeah, just less probable. It doesn't mean that it will not play, it will play out, but I mean, it doesn't mean that it will not play out, but it's just less likely to hold. So yeah, these are three my criterias. If all of them three are met, I'm more happy, and like I'm more than happy to take it. If lower time frame confluences are at the place too. Um, if the order block didn't really take liquidity, but there is some structural liquidity to take along the way to this order block, which I will show you just for now, then I'm still happy to take it if the lower time frame confluence is at the place. Okay, but if it didn't really break the structure, um, which is this one, right, the second one, I'm not looking at the order block. Okay. Okay, so I think we may as well delete it. Yeah. So now the next point which I wanted to uh, talk about is order blocks that looked like this. Okay, so we have this movement to the downside, then a little retracement back, and then an impulsive continuation to the downside, right? What I don't really like, or what I want to see from movements like this, is that we have supply in here, um, supply, and the anticipation is that we will somewhat correctively, right, get into the supply, mitigate it, show some um, lower time frame intention to the downside, and then go to the downside, right? Um, the problem is with such examples is that within this leg, um, which I will make just for now yellow, is that this high, at least in this example, didn't really sweep liquidity in here. All right. So even though we had an expansion to the downside, this high didn't really sweep the liquidity to the left. And whenever price comes to the supply, there is still may not be enough liquidity to the bringing the price to the downside. In this case, it's really important to have uh, structural liquidity, or simply saying a high like that. Okay, so this is the same example but with structural liquidity. So this is our supply, and this high is our structural liquidity, because, or inducement, you can call it whatever you want. And in this case, we, as you can see, we might have reacted already to this supply, but we failed to follow through and to break even this low, right? The follow through means that we didn't really break neither this low nor that nor this one, right? which means that this high and this reaction overall was used to accumulate liquidity above these high and then to bring the price back to the supply and then sweep the liquidity above this high and then to go to the downside. All right. So this is the example with structural liquidity. And on top of that, of course, we have in both examples sell side liquidity to sweep, which once again indicates us that the market moves from liquidity to liquidity. As soon as we have filled this liquidity void, we target the next liquidity point or pool. And in here we have a different situation. We have a little less liquidity pool at first, but then we have a lot of liquidity accumulated above this high and in this zone. So the high then comes, sweeps it, mitigates the maybe even refined supply already, and then targets the sell side liquidity. Okay. So yeah, in this cases, we always want to see some structural liquidity to be at place. Okay, because now I will delete it and then I will show a real chart example of what may happen if we don't really have any structural liquidity, right? So as you can see, the pair euro US dollar, the price action of from today, if I'm not really mistaken, no, it's from 13th of December. Okay, so it's from yesterday. So we have this piece of price action, and we have this order block in here. Okay, we have this order block in here. This is our supply. It is valid. Not, it doesn't meet any, like, all the three criteria of mine, but it broke the structure impulsively, and it broke this demand and this, I mean, overall the supply, the demand chain, which means that we can be looking for sells. And as you can see, the price actually gives some reaction to this supply with this one candle, right? What then happens? The price reverses and goes to mitigate the higher order blocks. Okay, so the reason why is what I have just told you. Like, do we sweep any liquidity in this area? Not really. We go down, we then retrace, and then once again we fall. Did we sweep any liquidity? No. Was there some structural liquidity between this area? Not really, right? Which means that we may anticipate the reaction, but we will not be having the follow through, which means that this week low for now will remain to be the strong high. Okay, so the price then continues going back to the downside, to the upside, sorry, to seek liquidity to fuel the price lower and to mitigate some important zones. Once again, we have this good looking order block, right? That I have marked out. We once again break the low and we show reaction with these two candles. But why there is no follow through up to here, down to here? Well, did we sweep any liquidity? Not really. We have created a double top. which means that we may as well get swept. The price does what? Reacts to the downside, goes to the upside, sweeps the liquidity above these highs and all these three highs. Okay, we then have this inside bar candle and the wick, which then creates the supply zone that has flipped the demand. Okay, demand is valid because it has broken the structure. And what do we see in here? Well, oops. What we see is actually we wick the demand, which means that we only sweep the liquidity. We then show an aggressive reaction of the supply. We don't close above the supply, which means that supply held, and then we go to the downside. All right. Which means that this piece of price action is a complex pullback where we had two breaks of structure in order to mitigate one valid supply, and we have swept all these highs as our structural liquidity to fuel the move to the downside. All right. The same goes with this demand. Like, it's pretty valid. We had impulsive push to the upside. We have broken the structure. Why there was no follow through? Well, did this demand break anything? Sweep the liquidity? Not really. We just, retraced back, went up. So that means that it will probably get swept, and it actually did get swept. Okay. Plus, the fourth thing that you can do in order to understand if that supplier demand may be valid is the pricing, right? We always want to be selling from the premium zone and buying from the discount zone. And this is the case right now. As you can see, this demand is in premium zone, so the buys from here are less valid, which means that we are selling and we're doing it right way. This supply is, as you can see once again, at the equilibrium, and this is not even at equilibrium yet, so this is risky because we are at discount zone, so we want to be buying. But whenever the price has come to the the premium zone, which is the red one, right? The price has showed a great intention to go to the downside. But then when it came back to the discount zone, it has mitigated somewhat demand in here. It has swept the liquidity below these lows, and then went higher to mitigate the last unmitigated supply. I'm not taking into consideration extreme right now. We are now back into the premium zone, and then here it goes. Okay. So summarizing everything above, we have not even 3 but 4 things that are criteria to filter our order blocks or supply and demands. The first one, as I have said, is did the order block or supply and demand break the structure? Yes. Okay, valid. It is valid. No, it is not valid. Did it take the liquidity out? If yes, then that's perfect. If not, then you can anticipate the reaction. You can still trade it, but it's just less likely to hold because we need we need liquidity to fuel the move. And keep in mind, if we have then any structural liquidity on the way, like as I have said, these three highs, then this order block is likely to hold because we sweep these highs, we have liquidity, we also sweep the liquidity above the order block itself, and then we go to the downside, right? The third one is pricing, premium discount. If it's in premium, we want to be selling. If it is discount, we want to be buying. If it's equilibrium, we actually want to be staying out of it because the price is fair, which means that it can go both directions. And the fourth one is and the fourth one is what the move looks like. If it's impulsive, then it is more than good. If it's corrective, that means that there is an intention to bring the price lower or higher, but it is not that strong as the impulsive one. Okay, which means that the banks and financial institutions are staying behind it. And yeah, these are the four that I am using in my trading. And yeah, I think just for now, 35 minutes of me explaining the theory will be enough for you. So I think let's get into the trade recap. And the 15-minute idea was that we were in a range. As you can see, we were in a range between this swing high and this swing low. We had this big void of liquidity. There's a void of liquidity, which means that you trade the edges of the range. You sell from the supply, extreme supply. You buy from the extreme demand, which is this one in case of today's price action. And I was at first looking at selling from this extreme, but I missed the opportunity. Let me show it to you. Okay. So just wasn't on the charts because when I have then backtested the price action in here, it was so clear that I was kind of sad that I didn't really catch it. So as you can see, we started on our way to the supply. We started being more so corrective, right? But then we once again structure is the king, right? If you think that the structure is doing something like this and then it breaks the low, then you are in this case wrong, because these two candles or these two candles, this is not a structure, it's only a pause, which means that if you were looking for the chalk in this case and you have picked this low as the lowest point, then you were right. If you picked this or even this low as the lowest point of your leg, then you are wrong, because you would have been then stopped out if you were to sell from this order block. Okay. So yeah, we have these cumulative trendline liquidity that got swept with all these highs. They have swept then that, and then we have this demand. We have change of character. We mitigate the supply. We liquidate these highs. We, as you can see, show some V-shaped recovery, which means that the aggressive rejection from the supply zone, which shows that there is an intention to bring the price or to the downside in this case, or to reverse the price. We then have change of character, sweep of high. This is our new high. This is the low that has created this high. We have swept this high, this low with these candles, and we have flip. This is our demand that has created uh, this high and have swept this high. We show some reaction to this demand, but then we sweep it. Okay, and 1 minute or it is even 3 minute water block is this big red rectangle. Um, 1 minute, as you can see, is this little inside bar candle. Okay. Why is this valid? Well, because we have, as you can see, these highs as inducement. We then go 5 seconds. I will not go 5 seconds for this particular example because I think it will take too much time. Actually, you know what? I will. We go in 5 seconds. The price comes to the supply right here. It breaks the high, as you can see. It breaks the high. So this is our new low now. Not this one, okay? This one. It breaks the low. With this push to the downside, which means that this whole range, because it's 5 seconds, right? We don't really want to over refine it to this candle. Like in this case, it would have played out, but we don't really need that 0.2 pip stop loss, okay? So we take this whole range as our supply, and we sell it from there. If you're still not sure, then you mitigate, then you mark this supply out. We have this change of character, which means that we sell from this candle. Boom, it goes. Okay. And once again, since we're in the range, oops. Oh my god. Since we're in a range, we trade the edges, and that means that the target is this weak low. So you just, put the target all the way up to here, okay? So then I play the price forward. We go in 1 minute, and this is where I was like watching. We had this break of structure, and like I firstly was looking at this area, but then we once again have broken this point of structure, and I stopped looking at this area because I saw that we have actually mitigated this area, and the new area was a continuation of a supply chain which had already these two highs as structural liquidity, so we don't really need to sweep anything in here. And this is where I was like waiting for a price to hit my refined supply. It then created a new high, which is once again a structural liquidity. And then at this point, as you can see, we have our tap into the supply zone. Then we go on 15 seconds. This is our last high, which means that this is our last low that we want to see get swept in order to see our change of character. This is our demand that we want to see a reaction from, and then we want to see a further break of it. So we stare at the price. Price does nothing. We then, as you can see, wick the demand. We show the reaction in these candles with the wicks, which means that we have now our new supply zone. I didn't take this wick only because I didn't really want to over refine thing. So I took this buy to sell, and then I just wait for price to come back into the zone, and we have these two highs and these two or three highs as structural liquidity. So then I go on 5 seconds, and then as you see, we have swept the high. As you can see, we have swept the high. This is our new low, which means that we need to get, we need to see this low get broken. Oh my god. The price does so, shows commitment to the downside, and then I sold it when I saw this big reaction from the refined supply zone. So we have, then I'm not actually like leaving it just run. We have this sell side liquidity above the demand that is a extreme demand that has you know, helped the price to reach our supply, this one supply. So I am looking at the reaction from this demand, and then I want to see this demand fail and to trade from the supply that has taken out the demand. So we then show some great reaction to the downside. We then once again show some great reaction, but then we show, as you can see, we show the reaction to the demand within these candles. And in here, if you're not trading seconds, don't really get scared of how it looks like. Whenever you get used to that, it will become much more easier. But yeah, the same thing goes and applies to seconds time frame. Why didn't I mean, we have swept or broken the demand at this point, right? Why didn't I then sell from this point? Well, because these highs didn't really sweep any liquidity, which means that they will get swept, which means this is our structural liquidity for this range of candles, which means that we now set the limit or manually execute it, and then the price, as you can see, zero drawdown, and then the price just commits to the downside and goes. Okay. So yeah, two great trades. The first one is 1 pip stop loss, the second is 2 pip stop loss. But in this case, it could have been like 1 because, you know, at this point when we showed the reaction already from the supply, we don't really need to go back up higher. But just for safety, I didn't really put it 1 pip stop loss. So yeah, and then the price just goes, as you can see, shows great momentum and then closes me out at profit at that unmitigated demand, which is actually my fault because even though we had a great, you know, reaction to the upside, it was a weak low because we failed to break this high, which means that most likely will sweep it, and as you can see that has actually happened afterwards. But yeah, this is a part of trading, and I mean, sometimes you're right, sometimes you're wrong, and since we was like um, inside the range, I still thought we may probably go higher to mitigate this, let's say, supply, but we failed, and yeah, you fail, you learn, even though sometimes this lesson may cost you a lot of money, right? So just for now, I think it's a lot already enough of information for you, and maybe even too much. But yeah, I think you have enjoyed this video. I hope you have enjoyed it, and I hope you will benefit from it. I hope you will find a lot of useful information for you there. Um, I may be saying the things complicated. My drawings may not be the best ones, but um, if you think that I can somehow improve my um, teaching or something like that, I mean, explanation, then just let me know if you don't really get it. Then I will try to make it simpler so you all guys will understand that. But yeah, as soon as you actually put the work in, we'll practice and we'll know all the why behind the move of price. Um, it just, it becomes really easy, and the way it is easy will then shock you. Okay, and for the ones that are not there yet, but they want to do that, and let's say you're looking at these tight, super tight stop losses, right? Don't really chase it. Don't really go and trade from seconds time frame. You just need to get used to 1 minute time frame at first, and then go on seconds, because when it comes to the seconds, the price action there is really messy, and sometimes you don't really understand if you need to account those gaps or not, or what range of order block should you consider as the valid supply or demand, right? Like there are a lot of different stuff that you know that are different from minute. But yeah, at the end of the day, when you are profitable in 1 minute, the seconds will be easy for you to, because um, you know, as I have said, time doesn't know price, price doesn't know time. It's just the same data in different time perspective. That's it. Um, but yeah, uh, the most important is structure, and when you know the structure and what the price is doing and what it wants to do, and what it shows you, then yeah, any time frame is the one that you can benefit from. But yeah, I think I will stop waffling for now. 54 minutes of the video. Once again, long, but I hope it will be really, really useful for you. Let me know what you think about this video. Let me know if you liked it or not. Let me know how can I improve, or what content should I post. Uh, but yeah, just for now, thanks for tuning in. I hope you liked it. Have a great day.